Matt, let's talk a little bit about the kinds of challenges that investors face. If an investor comes to you and says, I'm with an endowment or a foundation, and we have decided we want to shift our portfolio away from exposure to fossil fuels, either entirely or in part, what kinds of risks, what kinds of challenges of definition or exposure or structure or category do you find they're likely to face? How do you counsel?
Sure. No, that's great, and we've been working on that for a long time. And importantly, we do offer that service, so we'd be happy to take that call, I suppose I would say, as far as fossil fuel free investing. But we spend a lot of time trying to substitute away from that. So we think about from a judgment standpoint, what are likely to do well in a period of rising oil prices if you're not having any oil exposure. Clearly, energy efficiency is an area that you would see that. One of the key challenges, I think, though, is that when you're looking at energy efficiency or renewable energy, you have your own cycle within that. And you asked about the last 5 or 6 years also, and I was thinking about how dramatic you've had a cycle within renewable energy or LED lighting, where you've had dramatic demand, and then a supply response, and then collapse. And so being able to understand the dynamics of both the supply-demand outlook for the primary issue, that would be primary energy, oil, et cetera, electricity, as well as the secondary or the derivative market, which would be renewable energy and energy efficiency, is one of the key challenges that we have. So we specifically don't want to blindly rebalance towards other things, whether it would be the easiest thing would be towards other commodity-related companies, be it in the services space or other types of commodities. But that's not what we want to do. We want to find other ways to participate, whether it's through in the utility space, where water and waste services, again, would be another place that you mentioned, an area that we've invested historically, and other commodities. But the other thing that I would clearly say is that the challenge in a period where you have rapid changes in oil prices, the portfolio, it's difficult to keep up on the upside, and on the other side, and to our benefit, clearly in a period of falling oil prices, it's a wind at your back. So I'd say those are the types of things that we come across. How do we substitute around it, both from a judgment standpoint as well as a portfolio optimization tool or using some quantitative tools? What are the underlying cycles within the cycle of the different markets? And what are the performance expectations for the different environments?
Thanks. Anybody else on that topic?
Sure. Yeah, I can jump in a little bit. So, I mean, I talked a little bit about kind of the diversification challenges and some of the things that are happening there. In the portfolio that we run, we have about 34 either labeled green bonds or bonds that are that would be supporting solar farms or anything like that. And in the past year, we've done about 14 new issues in the green bond space. So, I think, we've been able to, that being said, we have our agency bonds and our agency mortgage-backed securities and things, but we still feel like, there's a decent amount of space and actually pretty interesting green bond, mostly in the labeled green bond space. A lot of that, again, is in that kind of supra-sovereign agency space. And so you're not getting a lot of spread necessarily. But from our perspective, when we have agency bonds, you have a Fannie or Freddie or FHLB or something like that, if you can get the same spread or maybe a basis point or two better, and you can do something that's supporting a green bond, from our perspective, we do that swap all day long, because I'd rather do something that's going to be positive than just kind of a negligible impact necessarily. So, we're still seeing a decent number of new issues that are, being brought from Citi or Morgan Stanley or lots of different other players. Again, we're hopeful that to have a really good diversified portfolio would be great if there would be some more things in kind of, LEED certified mortgage-backed securities or in the corporate green bond space. I think those are some of the spots that's some of the challenges that are occurring, at least in the fixed income market, is that we need more sectors to be able to issue some of these types of things. But it's because there's some of these challenges doesn't mean that there aren't lots and lots of interesting deals that are still coming out. There really are, and they're continuing to do new and innovative things. So it's an exciting time.
So Val, if you had a client of the bank come to you and say that they wanted to find a way to craft a greener portfolio, how do you help them think about the kinds of trade-offs that they may have to make in order to accomplish that? So let's take a case of we had an investor, a small endowment come to us and say that they were going 100% fossil free, and we were one out of 15 managers who they were allocating money to. If they came to you for advice, what would you tell them to expect if they had to make that kind of a choice? What trade-offs might there be in terms of return, diversification? How would you describe it?
Well, so I'll answer that question in a slightly different way, because Citi does not have an investment management business, so we don't have clients coming to us asking about how to manage their portfolios and about how to specifically invest their money. But I can speak to if we had a general traditional industry corporate client come to us and they wanted to, say, emphasize one piece of their business through the issuance of a green bond. Which I think, to Benji's point, is still a really exciting, emerging new space that I think we'll see more definition around relatively quickly. I think I would, and this is partly to meet needs of different investors and partly to assuage concerns that different investors might have about the green market space, I think we would certainly refer them to the green bond principles, whose core tenet is really focused on transparency, transparency, transparency. I think that particularly for clients in traditional industries, having as much transparency as you possibly can about the use of proceeds is, and you know, how the proceeds are used, when they're used, is to everybody's benefit. I think we see a lot of credible third-party support, advice. It's certainly not required to be a green bond to have a third-party certification, but we are seeing a lot of activity in that space and seeing some really credible actors. I think, you know, the whole question, the broader question of sort of this carrot versus stick, something that I think ICCR members are very well practiced at. It's an interesting question always, and I think we're at a really interesting point when thinking about that right now, with this sort of tension, I think, even in the agenda today between the discussions about divestment versus the discussions about how to do even more low carbon finance. I think there's a place for both. I know that we certainly, with our own corporate clients, spend a lot of time working with companies to help them to manage the environmental and social risks associated with traditional activities, making sure that they can meet international standards. But much the same way that ICCR members come to Citigroup and ask us tough questions, but also encourage us to do, through their engagement, more and more of the environmentally positive financing, I think that there's also really a place for us with our corporate clients, for my colleagues with their clients, to encourage engagement and sort of the use of positive psychology when you're engaging with the companies that you invest in, so that you can really help to incentivize more of the environmentally positive activity.